All right, so if you've been watching news lately, you already know something pretty significant is happening in the Middle East right now. Oil prices are moving, markets are reacting, and gold is doing something kind of interesting. But here's the thing, most people don't really understand why gold is behaving the way it is, and more importantly, what it might do next. So today, I want to walk you through what exactly is going on, how this compares to similar situations in the past, and what it could mean for anyone holding gold or thinking about buying some. So let's keep it simple, beginner friendly, and let's dive into it. First, a little history, because honestly, you can't understand what's happening today without looking at what happened before. The Middle East has basically been in some kind of conflict nonstop since 1979. That's nearly 50 years of on and off war, revolutions, and tensions. But here's the wild thing. For most of that time, oil supply was barely disrupted. Like, yes, prices have spiked here and there, but the actual flow of oil has always kept moving. The big exceptions were in the late 70s and 90s when the Iranian Revolution in 1979 knocked about 7% of the world's oil offline basically overnight. Then you had the Iran Iraq War through most of the 80s, where both countries were literally targeting each other's oil tankers. And in the 1990s, Iraq invaded Kuwait and that took out another chunk of the global supply. Every single one of these events sent oil prices through the roof, and every single one of those events caused a ripple effect in the US economy that you and I would recognize today as inflation. Quick one, if you're finding these videos useful, make sure you hit the subscribe, drop a like, and drop a comment. It generally helps out, and let's get back to it. So let's fast forward to today. Why does this current conflict matter much more than the last 30 years of the Middle East tensions? Because the scale is much bigger. We're talking about potentially up to 20% of the world's oil supply being disrupted. And that's not a typo. One of every 5 barrels of oil moving around the planet could be affected. The International Energy Agency is already calling this the largest oil disruption in the history of the global oil market, bigger than the 70s and bigger than the Iraq invasion of Kuwait. This is bigger than anything we've ever seen before. And here's the key point that a lot of people are missing. The oil itself still exists. Nobody's blown up the oil fields. The problem right now is transportation. The ships, the shipping lanes, and the choke points. When you can't move the oil, it might as well become non-existent from the market's perspective. Now, the good news is that the supply chains can adapt. There are alternative routes, they just take longer and cost more. So this isn't a permanent crisis, but it's a real one and it's going to affect prices in the short to medium term. This is where it gets really interesting for us gold stackers. When the 1979 Iranian Revolution hit, gold absolutely ripped. We're talking over 260% in a single year. That's insane. If you owned gold going into that, you made life-changing money. But then something unexpected happened. The Federal Reserve Chairman at the time, a guy named Paul Volcker, decided the only way to kill inflation was to hike interest rates to 20%. That's not a mortgage rate, that's what saving accounts were paying back then just for holding money in a savings account. And when rates go that high, suddenly gold becomes less attractive. Why? Because gold doesn't pay you anything. It just sits there, but an 18% treasury bond is paying you almost one-fifth of your money back every year just for holding it. So a lot of people sold their gold and moved back into bonds. The result? Gold entered a brutal bear market for most of the 1980s. Even though there was a recession, even though there was geopolitical chaos, gold went down because the Fed was hiking instead of cutting rates. So here's the million-dollar question. Is history going to repeat itself? Maybe, but probably not exactly. The current Fed chair, Jerome Powell, openly admires Paul Volcker. He literally carries around a copy of his memoir, and the Fed has been signaling that they're willing to keep rates higher for much longer, and even possibly hike more to fight inflation if oil prices stay elevated. Gold actually sold off a bit on this news as investors remember what happened last time. But here's some huge differences this time around. First, the US government is sitting on a massive amount of debt, way more than in the 1980s. Hiking rates aggressively when you owe this much money is a recipe for disaster because it jacks up the cost of paying interest on that debt. That's a real limit on how much the Fed can actually do. Secondly, Powell's time as the Fed chair is basically up. His term ends very soon, and Kevin Warsh has been nominated to replace him. which means whatever decisions are made from here on out could look very different than what Powell would have done. And thirdly, gold trading has changed completely. In the 80s, the price of gold was basically set in London and New York. That was it. Today, we've got the Shanghai Gold Exchange, the Indian market, and massive retail ETFs and all kinds of global players. In fact, about two-thirds of the trading days this year, gold prices have been led by Asian markets, not the US. That's a huge shift. What the Fed does still matters a lot, but it does not own the whole conversation anymore. So, if you're holding gold right now or thinking about buying some, don't freak out about the short term price swings. Gold is going to bounce around as headlines come out of the Middle East. That's completely normal. The real story is watching three things. Number one, what actually happens with oil supply long term? Is this just a 6 month disruption or a multiple year thing? Number two, what the Fed actually does, not what they say they're going to do. Those can be two different things. And number three, what the global demand looks like for gold, especially from Asia and other world governments. If rates stay high and inflation gets crushed, gold can continue to struggle in the short term, just like in the 1980s. But if that level forces the Fed to back off, or the international demand keeps buying, if the international demand keeps pushing prices higher, regardless of the US policy, gold could have a serious run. Either way, I personally don't think this is the moment to panic or chase the hype. Gold has always been a long term asset. It does best when you hold it through all the noise and let it do its job as a hedge against uncertainty. And right now, there's plenty of uncertainty to go around. Nonetheless, that's how I see the situation in the Middle East at the moment. The conflict is real, the impact from the oil markets is real, but gold's response is more complicated than when there's war, gold goes up. You've got the Fed, global markets, and debt levels pulling us in all different directions. If you found this helpful, drop a like, subscribe. I put out videos every week breaking down precious metals in plain English, and let me know in the comments what you're doing with your gold right now. Stacking, selling, holding.